direct listing, NASDAQ direct listing. You may have heard that NASDAQ has requested to offer direct listing for shares. It's filed that request with the SEC. But in this video, we're also going to talk about Palantir's direct listing. Okay, so let's begin with Palantir. And here on Bloomberg, it says Palantir files for direct listing with tech IPO surging. Palantir Technologies Inc., the data mining company backed by tech billionaire Peter Thiel, broke years of suspense by going public through a direct listing. The Denver-based company applied to list on the New York Stock Exchange under the ticker PLTR, according to its filing Tuesday with the U.S. Securities and Exchange Commission. That was Tuesday, the 25th of August 2020. Palantir won't raise any proceeds in the listing and doesn't have traditional underwriters. Contrast with previous direct listings, though, investors will face restrictions on how much of their shares they can sell initially. Like many tech companies that have headed to the public markets, Palantir has never been profitable. The company lost $580 billion in 2019, though that loss narrowed in the first half of this year to $165 billion, according to the filing. Revenue in the first half of the year climbed 49% from the previous year to hit $481 million. The company has said it expects to break even this year. Palantir's founders will control about half of the total voting power. The company currently has two classes of shares and plans to add a third class that carries a variable number of votes. All shares of this new class will be held by a voting trust established by co-founder Alexander Karp, Stephen Cohen, and Thiel. Palantir joined a stampede of companies that have filed to go public this week, including Unity Software Inc., Sumo Logic Inc., JFrog Inc., and Snowflakes Inc., as well as multi-blank check entities. Equity issuance has sprung back from an initial pandemic-induced lull with a vengeance. July, with almost $19 billion in new listings, was the busiest month for US IPO since September 2014, when 36 companies went public, raising $33 billion, according to data compiled by Bloomberg. The rush to the public markets comes as the economic downturn caused by the pandemic has led some companies to rethink their capital needs. Airbnb Inc., which was previously seen as a candidate for direct listing, said this month that it filed for a traditional initial public offering. Instead of underwriters, Palantir has tapped investment banks as financial advisors, as it wouldn't raise any proceeds in the listing. Morgan Stanley is the sole advisor to the designated market maker, which facilitates the shares opening, trading, and helps determine prices. Meanwhile, 11 other banks, including Credit Suisse, AG, Goldman Sachs, Group Inc., Allen Co., and Real Bank of Canada will also serve as advisors. Okay, this is under coverage here on SeekingAlpha, and they have some summary here. Palantir Technologies has filed for its long-awaited IPO that could come as soon as next month. When was this written? This was written yesterday, August 26th. The company is opting for a direct listing format like Spotify, foregoing a capital raise. The company has raised a cumulative $2.6 billion and is reported to be worth $20 to $26 billion in private markets. Palantir generated $743 million in revenue last year. Growth in the first half of the financial year 2020 has accelerated to 49% year over year, almost unheard for a company of Palantir's scale. Okay, so we have here the disclosure itself. You're going to find this link and the others in the description box below. So we'll go down and quickly have a look at the cash flow statement. So we'll follow this link here, indexed to consolidated financial statements, and then we have it here, consolidated statements of cash flows. So operating activities, net loss, okay, for end of the first half of this year 2020, $164 million. And what do we have here? Accounts receivable, it's a negative $56.5 million. Accounts payable, $35.5 million. Accrued liabilities, that's $8.2 million. Customer deposits and current and non-current, $124.4 million. Investment activities, purchase of property and equipment, $5.9 million. Net cash used in investment activities, $5.6 million. Financing activities, proceeds from issuance of common stock, net issuance of issuance costs, okay, $542 million, $542.9 million, I should say. Proceeds from issuance of debt, net of borrowings cost, 149.6, I'll call it $150 million. Principal payments on borrowings, $250 million. Other financing activities, proceeds from exercise of common stock options, $28.8 million. Net cash provided by financing activities, $457.2 million. Effect of exchange rate, not much on them, $197,000. Net decrease, okay, net or decrease or increase in cash equivalents and restricted cash is $235 million. Net cash equivalents and restricted cash at the beginning of the period is $101.4 billion. Okay, at the end of the net cash equivalents and restricted cash at the end of the period is $1.63 billion. Okay, so I think, if I'm correct me if I'm wrong, this is probably this is the amount of the value of all the assets that can easily be liquidated to cash. So fair enough, it's quite liquid to some extent, yeah. So they're not exactly running into very high figures here in transactions. Changes in operating and asset liabilities, accounts receivable, okay, 556 million, okay, and prepaid expenses and other current assets, okay. So I think this looks fairly decent, I guess, fairly decent. $1.63 billion in net in cash and cash equivalents at the end of the period, which will still be what it is now. That is what they will be working with as at now, and they have no need to raise more funds. So one might be tempted to assume that they have probably much of this will be cash. Probably much of that will be cash, okay? And net cash provided by financing activities, $467 million. Okay. So, which is probably the most liquid of all the assets, $466 million. And then this is what again? This is net decrease or increase in cash equivalents. Okay, so it was an increase. Okay, so well, this is more on the cash flow as well. Okay. Remember, you will see this the link to this disclosure. This is an S1 disclosure. You can see it here. It's Form S1 registration statement under the Securities Act of 1933. You will find it in the link to this in the description box below. And so we go back and see what direct listing is all about. This is how NASDAQ has described it for us. A direct listing allows companies to list on NASDAQ without concurrently raising capital. Typically, a company will list securities on a national securities exchange to provide restricted liquidity to existing shareholders and to raise capital via an IPO offering. What is a direct listing? A direct listing enables the companies to access the public markets with a direct listing. With a direct listing, existing shareholders sell their shares on the open market and no additional shares are offered to the public. Okay, what is the difference between an IPO and a direct listing? When a company decides to go public, there are typically existing shareholders, including founders, employees, and various early-stage investors. Both an IPO and a direct listing enables these investors to cash out. However, in an IPO, there is a lock-up period, typically between 90 to 180 days, in which shareholders are restricted from selling outside of the initial public offering. In a direct listing, there are no lockup restrictions. So meaning that what this means is not exactly clearly spelled out here. It means that once the IPO has been initiated, the existing shareholders who may be indicated, because not all the existing shareholders will be may be restricted, so it depends on the company to disclose who are under restriction, I suppose. Based on our own experience, we know that people have to maybe indicated, but there's also a chance that existing shareholders are very likely to be people who are also privy to critical information about the company, private to sensitive information about the company. So it makes sense to say that all the existing shareholders may be restricted. So, and then when a company decides to go public, there are typically an existing shareholder. There are typically existing shareholders, including the founders, employees, and various early-stage investors. Both an IPO and a direct listing enable these investors to cash out. However, in this IPO, there is a lockup period. Okay, well, this is where they mixed up things here. Okay, so we've explained it, and then in this case, how does the pricing process differ between an IPO and a direct listing? An IPO is priced based on the size and number of orders received at different price levels throughout the roadshow. The lead underwriters typically determine the IPO price based on this information. Conversely, a direct listing has a reference price, which isn't the offering price, but rather the calculated price of the shares after all the buy and sell orders have been received from broker dealers. The reference price is used to open the stock. Transparency is critical in calculating the right price, the right reference price, and helps reduce the chance of price volatility once the stock opens for trading. NASDAQ's suite of IPO tools and proprietary auction technology helps to provide for control and data transparency to mitigate volatility. So the people who are going to the reference price is just to help us. Yes. So the people who will be working with this reference price are the market makers, and we can see here it's indicated instead of underwriters. Palantir has tapped in the investment banks as financial advisors, as it won't raise any proceeds in the listing. Morgan Stanley is the sole advisor to the designated market maker. So this market maker, the designated market maker, is the company that will initiate the first sale of Palantir shares on, in this case, it's not NASDAQ. It will be on the New York Stock Exchange. So Morgan Stanley is the advisor, the sole advisor to that market maker. So we felt the need to provide you folks with this little piece of information. Direct listings are not exactly very new as such, but what is new in this is Palantir. Palantir is going public, and also that NASDAQ is trying to also offer direct listing. Now NASDAQ is competing with the New York Stock Exchange, and once this becomes quite popular, it may affect investment bankers, because if people are not doing the regular IPOs and raising funds, then it can affect their income. But they will always find a way to make money. People will still be doing IPOs because people will still need to raise funds, and businesses or firms will still need to raise funds. But if indeed direct listings are becoming popular, they will still find a way to get involved and get things rolling. So I am aware that for a company to actually list on NASDAQ, it probably has to have up to $50 million in revenue or thereabout, and more. So thank you very much for watching this video, and don't fail to subscribe to our channel and hit that notification bell as well.